The Fed hiked 75 bips for the first time since 1994, and stocks head lower, taking the S&P's losing streak to 10 out of 11 weeks. The dollar pauses as other central banks play catch up and turn marginally hawkish. And oil finally pulls back from highs, joining industrial metals in sniffing out a potential global recession looming. All this and more in this week's Macro Insight. All right, so welcome back to Macro Insight, everyone. Today is the 21st of June, and let's take a look at these markets. So last week, obviously the long-awaited FOMC, they had leaked, as we'd flagged, they'd kind of leaked that they were going to go 75, and that was looking like, pretty much a done deal, and it would actually be detrimental to them to not go 75 because that would be seen as a bit of a shock to markets. And so they did deliver the 75 bip hike as expected. If we look at what the kind of big movers were on the week, we had other rates markets actually kind of moving quite dramatically. So you saw Sweden, New Zealand, Australia rates all kind of ratcheting up about 3 standard deviations. It's kind of catching up with what we've been seeing out of the Fed. Just generally, all central banks coming a bit more hawkish. Swiss National Bank also surprising with a 50 bip hike, so a bit marginally hawkish there. ECB announcing the potential to reinvest some of their PEPP redemptions into the Italian bonds and peripheral bond market as part of their kind of crisis management anti-fragmentation tool that they're talking about. So trying to get a bit more credibility around that and saying what actually they're planning to do. And that triggered a bit of a tightening in Bund BTPs and things like that and a bit of a bounce in euro. So global stocks obviously took a hit. We see the Kospi down the worst there. Again, about 3.5 standard deviations down as kind of global recession fears kick in, where we may be heading. S&P also had its worst week since March 2020 and is now down 10 out of 11 weeks. So it's about as bad as it gets, right? I mean, that's a pretty horrendous run and something we haven't seen since probably 2008 or worse, right? Now, what else? Credit also continues to widen, so seeing wider credit spreads. Commodities, energy finally took a breather. Natural gas obviously getting hit pretty hard, but also oil, uranium, things like that all pulling back. And industrial metals continued their slump as demand concerns are weighing them down. Gold and silver were steady. Actually, silver a little bit up, gold pretty flat. But crypto obviously trashed, making new cycle lows over the weekend below 20K on Bitcoin. So that's kind of your summary for like the major moves. In terms of some of the sort of data points that people have been throwing around, shorts were being pressed, even though we were like at lows. We were seeing quite a lot of shorting still from some of the flow data. So GS's prime flow was seeing, Z scores on shorting being quite high. Let me bring up this chart. Here, week on week short flows, 10th of June to 16th of June. You see this spike down. Like we were saying earlier, we might have been covering shorts because we've been bearish for a while. There are still people out there actively pressing on the short side, or they were last week, basically, right? So that's maybe slightly more encouraging for those looking for a short squeeze. If you also look at kind of the tech sector specifically, you look at the S&P technology members, S&P 500 technology members, over 90% of those are more than 20% below their peaks, i.e. in a bear market. If we go back to the 50s, this chart, I mean, it's probably quite hard to see, but this chart going back to the 50s and it highlights all those moments in time where that was the case, where that larger percentage were in a bear market. And obviously from a longer term, big picture perspective, that has tended to be an okay time to start, dabbling and getting involved, right? But that's not to say that you can't get a load of these red dots cluster and come together. So we may still need to work through the whole summer of bearishness before really something like this could be considered a counter indicator that you want to trade off, basically. So I wouldn't really trade off it, but just a chart that was out there that people are throwing around to just show how sort of, even though the S&P might not be that far off its highs, you know, a lot of stocks are in bear market mode and have been. So obviously we had the FOMC came out. Before the FOMC, the market had kind of leaked that 75 bips are coming. You'd had a bit of a knee-jerk sell-off down towards 3,700. That level had held. We were kind of ranging between 37 and 38. We then had quite extreme volatility around the FOMC, where we got a low print of 37 and a high print of 38.40, so 140 points. And these are hourly bars. So in a matter of 2 hours, that was like your round trip. And then obviously what often happens with these sort of data points is the market takes a little bit of time to digest, figure out what they think. And whereas the first move suggested that the market took some comfort from the idea that the Fed was going to be fast to get to neutral, call it 2.5%, and then they were going to slow down. And whilst they were still going to keep hiking, the pace of hikes after reaching neutral wasn't going to be that dramatic. That was kind of the excuse being given for why we rallied. But then ultimately the market decided to roll over. And then it looked like that 3,700 strike for June OPEX kind of became the kind of center of gravity there, where whilst we overshot first close to 36.20, which is the next expiry we need to talk about, but you know, it was looking like we were gravitating around 3,700 into the expiry. And now, you know, I'm of a strong belief that this 36.20 strike has been kind of driving this dynamic in skew and in underperformance of volatility recently, because it's a pretty large position the street holds in about $15 billion, right? And that's not a small amount of kind of short dated vol to be holding, right? So I would be surprised if we accelerate through this 36.20 area until after month end. If dealers are long this. Now, there may well be other options that dealers have sold against this that will then change that dynamic, right? And this long vol position will be kind of counteracted and swamped by that. But at the moment, because of the proximity of that strike, because of the size of that strike, and also because the price action we've seen is the market has bounced a couple of times as we've got into the vicinity of that strike, it does seem to be in play and it does seem to matter right now. Yeah. So I would almost lean on that as a bit of a stop and say, right, well, if the market manages to break away from 36.20, then it means that the selling is that strong and that heavy, and we're going to go down towards strikes that maybe dealers are short again. And I don't want to be long the market if that was to happen. But right here, right now, given that that seems like quite a strong body of support, you know, thinking we're probably going to get a bounce, maybe back to 38.50 or a little bit beyond in the short term, you can kind of lean on that 36 area as a stop, right? So I think being long, you know, from wherever 3,700 or where we were on Friday with a 36 stop, trying to play a move to 39 kind of seems sensible right now. Yeah, given the vol setup, right? That's my impression. Yeah. If you look at what the VIX has been doing, right? So, you know, I put this on my Twitter thread at the weekend, and it's like, you know, you're seeing quite sluggish VIX price action again as the market was making new lows, retesting those lows near 36.30. VIX just couldn't rally, couldn't make new highs, right? So we're seeing this kind of downtrending lower highs on the VIX, which again suggests that the street isn't reaching for vol, that they've got enough inventory right now. So often that's that volatility divergence that we talk about, sign of exhaustion, that a rally may be due, basically, right? So that's one thing. Another thing worth kind of noting is implied correlations, right? This isn't something that I flag that often, but basically, you know, I had to look at it just out of curiosity to see where correlation was, because we've been seeing a lot of, rather than sector rotation, we've been seeing kind of, you know, indiscriminate selling across sectors recently, right? So, you know, even the energies got whacked last week and everything's kind of getting sold, right? All the stuff people are holding. So just wanted to see what implied correlation numbers were, and no surprise that they are kind of near the year highs, basically, right? So usually that is also a bit of a sign that things are a bit stressed, and things may need a bit of a bounce, basically, right? Whereas implied correlations kind of drifted back up towards, since earnings we saw in April, basically implied correlations go low when we go into earnings because single stocks do their own thing and indices don't move too much. And then you get this, we've had this rally back up in implied correlations as the markets had this period of de-risking. So maybe another sign that this thing needs a bit of a cooling off period, basically, where implied correlations can drift back a bit as well. And we can see more rotation and less indiscriminate, like de-risking of all stocks. Yeah. Given how much they hiked, it would have been fair to assume that the dollar did all right last week, but actually the dollar paused. So struggled to really make any new highs. They obviously been on a tear, really testing some key long-term levels, broke out of that channel as we kind of flagged. It's losing a bit of momentum, right? So if you look at the momentum indicators, rolled over back to sort of around the 50 area, couldn't really hold at those highs. You got to think the reasoning is because, there's so much hawkishness priced into the Fed, but other central banks are starting to catch up now, right? So as we mentioned, the Riksbank, the RBA, the New Zealand, all of them are basically shifting to a more hawkish stance, and their short-term rates market is repricing massively higher, basically, right? So that's kind of weighing on the dollar because the marginal repricing of other currencies, right? The dollar was firmer against the likes of Canada and Brazil, some commodity currencies, as commodities pulled back a bit last week. But in general, even against the euro, like we said, the euro kind of staging a bit of a bounce as it was pretty beaten up, retesting that 103, 104 area and holding it, kind of giving the ECB the benefit of the doubt that they can do something on this fragmentation. Bund BTP's corrected back below 200 basis points. So these are all things that have kind of stopped the dollar from ripping higher, basically, right? And then even dollar yen, whilst it's now actually rallying back through 136, dollar yen last week had a bit of a pullback in anticipation of BOJ, even though in the end BOJ basically stuck with the program, basically, right, and kind of quadrupled down on their yield curve control. Look at oil in a bit more detail. I think oil's really the commodity we have to watch right now. If you look back at 2008, if you look at what oil has been doing now, right, S&P's rolled over 20+%. Oil's still pretty much at its highs. That's pretty unusual in terms of risk asset correlation. Now, similar sort of story happened in 2008, where you saw this divergence when S&P was already down 20%, and then oil started to catch up, right? So you get the recession kick in, oil can't escape that, and then it corrects sharply, basically. The question is, are we heading into that similar sort of playbook where oil is running out of upside now, and as markets continue to sell off, and if we do price in a recession, oil is going to sell off as well. Now, we are a bit different this time around because I think the supply issues are dramatically different. So it might be different this time, but it's good to kind of be aware of that analog, right? You also, if you look at XLE, dropped 20% last week. Often those energy stocks, they lead the commodity lower, right? Apparently those energy stocks, the way they're valued right now, are pricing oil at 70, 80. They're not pricing it at 110, right? So they're already kind of, if this turns into something, it may be those stocks are leading the commodity down, right? So again, we need to watch how XLE performs. If it can recover back in line with the commodity, or if it's continuing to underperform, that's going to be a potential lead indicator. And then the final thing you need to watch in oil is going to be the crack spreads. They're still pretty high, suggesting that there's very, very tight supply. The backwardation in the futures curve, that's, if those sort of things start to come down dramatically, then you would start to say, okay, looks like the oil story is turning, right? And we could have some $20, $30 type pullback in this thing, right? But for now, I'm probably giving the oil the benefit of the doubt, right? And saying that the bull story is still intact there, basically, right? Just want to mention copper. Some pretty big inflection point here on copper. obviously, we know that the supply-demand imbalance for the long term, assuming that we're moving towards electrification and decarbonisation, the whole ESG narrative means that there's a shitload of copper needed, and inventories are not exactly high. But you look at the price action, again, for those of you who didn't watch mine and Tony's podcast that was out at the weekend, price action is key. You've got to watch that, especially for short-term moves. And this 395 level in copper looks fragile. And if that was to break down, then a quick slide into that 350 area, which is another 10%, is pretty likely. And then you're looking at just a more meaningful correction of this move up since early 2020, basically, right? So it's nothing to say that we're breaking the long-term structural bull trend in copper. It's just that this first sort of level of support does look a bit fragile, and you need to watch for that break potential. Yeah. And you probably if we do get a bounce in risk assets in the next couple of weeks and you get a bounce in copper, maybe you want to put some hedges on against your longer term copper positions, because that type of break, if we are heading into kind of recessionary sort of territory later in the year, that break looks quite likely in copper, basically, right? So that's one thing I'd be careful of.